6 ways the rich escape taxes. So, how do the wealthy avoid paying taxes? The fact is that the majority of people are unaware of how much money they may save by taking advantage of these tax breaks. As a result, it's generally only the extremely wealthy who can utilize it. Today, we'll show you some creative methods that wealthy individuals use to avoid paying taxes and keep their trillions of dollars safe from governments all around the world.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Method number 1. Make it as an expense. The majority of well-off people generate the bulk of their income through enterprises. This allows them to deduct costs and reduce their taxable income by doing so. Most individuals are unaware that most businesses' costs may be deducted to lower your tax bill. Let's assume that you run a small firm and earn $200,000 each year in net revenue. If you don't have any costs, the entire $200,000 would be taxable. However, because most firms have expenses, the amount will reduce your profits. So if you deduct $100K in genuine business expenditures each year, your yearly net income would be $100K instead of the $200,000 in revenue, and that would have reduced your taxes by more than half. Expenses that are not business related, such as vacations and meals, are considered illegitimate. Overhead, supplies, employee training, and other items may all be written off. You can deduct a lot of your company's operations. Method number 2. Divert your income. What exactly do we imply by this? Well, as of 2017, the US corporate income tax rate was cut from 35 to 21%. This gave numerous firms in America the greatest potential to lower their taxable income. Some businesses choose to account in their earnings in countries where the tax rate is even lower. In the Cayman Islands, for example, income tax is not levied. It's a tiny island worth no income tax. There's no corporate inheritance fee or anything like that. In a nutshell, it's ideal for company owners. You may want to keep what you earn. Companies that are aware of their earnings in other countries have an edge because they can save money. Assume your company made $5 million less in income, you won't have to pay 35% income tax or $1.750 million if you pretend your firm earned $5 million less. Sounds like a paradise, doesn't it? But did you know that the Caymans have some of the strictest bank regulations in the world to protect and preserve your privacy? That's because it has no existing tax treaties with other countries. The country itself can shield offshore bank accounts from taxation. Finally, offshore corporations in the Caymans don't have to submit any actual financial reports to any government agency on Grand Cayman. Incorporation in Cayman Islands is incredibly simple and streamlined as previously stated. To top it all off, incorporation in the Caymans is absolutely free. Maybe that explains everything now. When it comes to those espionage movies, people usually flee to these remote islands for offshore banking, right? Tip number 3. Issue stock options. Stakeholders of a firm may be given stock options to help them save money on their tax burden. It is extremely useful for 2 major reasons. First, you can expense it as a cost, resulting in a paper profit reduction that isn't taxable. Second, the company's cash outflow is not caused by it. To put it another way, let's suppose you issue a stock and then record it as a business expense for some accounting reason, but no money changes hands. This implies firms can lower their earnings by paying for expenses, albeit at a higher rate of return. In addition, businesses that utilize this method may see the advantages of incentivizing their stock in order for the stock price to rise. Wouldn't you put your own effort into increasing the value of a stock you own from a company you created? So now that you know how to identify these techniques, the next step is to figure out how to apply them in your real-world situation. Tip number 4. Invest in real estate. The rich stay wealthy for a number of reasons, one of which is that they make their money work for them. Real estate investments are one way to do it. When you buy a property, you can benefit from several tax perks as well as decreased taxes. From an accounting standpoint, you may deduct the amount of income that is subject to tax, since you acquired a depreciable asset as a result of this. The IRS has a list of deductible costs that you can claim. Repairs, mortgages, and other expenses are just a few of the items on the list. Plus, the more money you spend on expenses, the more tax selling reduction is applicable to you. Although it is possible to depreciate a house, you must remember that selling an old home and purchasing a new one will result in tax. Fortunately, there is such a thing as a 1031 exchange, which permits you to postpone income taxes until you sell the property. However, it only works if you purchase a new home within 60 days of selling your old one. Tip number 5, income deferral. This is a reliable tax reduction technique. In contrast, taxable income is reduced by a contribution to an IRA. You may earn tax-free money when you work, but if you contribute funds to your IRA account, you don't have to pay taxes on it. Within a year, you can deduct the amount that was contributed from your taxable income. Isn't it clever? For example, if you make $500,000 a year and are in the highest tax bracket, your earnings are probably taxed up at a rate of 40%. But what if you could avoid the 40% tax and instead have part of your income only be taxed at 20%, which you can do using an IRA? You do not have to pay taxes if you make a contribution to the IRA. You should withdraw the funds rather than paying the tax when making a retail purchase. However, in retirement, you'll most likely be earning less than $500K per year, therefore your withdrawals would be taxed at a lower rate. Tip number 6, use your geographical tax law as leverage. Let's assume you develop your business in the heart of Silicon Valley, the tech central, but living in the state with the highest income tax rate in the US would eventually push your tolerance to its limits. With a state income tax rate of 13.3% for the top earners, you may as well see a large portion of your earnings go to the government. In the light of this, what measures can you take to avoid paying some of the other fees that you may be subjected to? Some individuals may not be aware that certain states have significantly lower income tax rates, such as Texas and Nevada. You might be able to save money by moving. Consider relocating to a state with lower and more friendly tax rules and rates in order to avoid paying tax. Then, once you've eliminated as much as possible, get started looking for a new innovative strategy that will help you reduce it even further. As you saw, these are just the tip of the iceberg when it comes to avoiding tax legally. To finish the loop, the amount of savings you've made through these strategies determines the tax difference.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.